Hello, everybody, and welcome to Sense of Security. Based on the current landscape, Q2 2026, earnings showing hyperscalers pushing combined 2026 CapEx guidance to roughly approximately 77% year over year, and Alphabet's first ever negative free cash flow, a growing reliance on debt financing, and persistent debates over GPU utilization versus real returns. We thought it would be good to review CapEx. So we're here with James Yendrey of InvestMentor to break this all down. Hi, James. How are you?
I'm doing well, Mary. Thanks for having me. How are you?
I'm doing great. Thanks for asking. Okay, so the first question, let's just get this out of the way. Please simply define what is CapEx and why it's important.
So CapEx is the money building long-term assets. Think like data centers, chips, servers. These things aren't necessarily expensed immediately. They're depreciated over years. And it's a company's bet on the future demand.
Yeah, so Goldman Sachs says hyperscalers will finance more than a third of their 2027 CapEx with debt. And we just saw Alphabet post its first negative free cash flow since going public in 2004. Are we watching the AI build out quietly transition from a self funded cash flow story to a leveraged bet? And what does that do to the risk profile if demand disappoints?
Lots to unpack there. So yeah,
Mm.
yes, Alphabet did post its post negative free cash flow for the first time in 22 years. And hyperscalers are basically on pace for roughly 33% in 2026 for CapEx, with that rising towards 35% in 2027 against an estimated 1.14 trillion. And so this is something that's a bit different that you would assume to see for hyperscalers, because cash funded CapEx has a self-correcting function within it. If demand disappoints, it is able to adjust accordingly. But if you have these over levered debt, you have a fixed interest and principal payments that don't necessarily care whether the GPU generates the revenue in the time horizon that was initially anticipated. So it's a shift from an equity-like risk to a leveraged risk.
So, is this strategic overbuilding for a demand curve everyone believes is coming, or are we building the AI equivalent of empty office towers?
Yeah. I would say the data is pretty stark in this regard. Average GPU utilization across, say, about 23,000 clusters sits at just 5%. So the strategic overbuilding has a precedent. Think of the early 90s when telecom laid fiber well ahead of its actual use case. But the issue is, those, in that same example, those fiber cables, they don't lose value. GPUs do lose value because you have a new one coming out every 12 to 18 months with better and faster features. And so a cluster of 5% utilization, it's not really waiting patiently. It's a wasted asset. So that means the bull case needs to arrive faster and not eventually.
So, the CapEx to sales ratios are hitting levels analysts call seemingly untenable, north of 80% for some infrastructure heavy players. At what point does the market stop rewarding growth at any cost and start punishing capital intensity the way it punished Meta in 2022? We don't know, but we can speculate a little bit, right?
Sure. It's a good one. CapEx to revenue has moved from 10 to 15%. This is like pre-AI to about 30% now. So Meta's 2022 stock drop. The market had stopped funding CapEx once it lost faith in the payoff story. So right now, it's not really about a specific ratio. It's more about the credibility, right? Investors had tolerated AWS and build out because the returns started to show up, right? Now they're pushing these vague narratives and shrinking free cash flow, hence buybacks, slowdowns across AI CapEx leaders. So Alphabet's stock reaction to its own CapEx raise suggests that we may already be nearing an influx point.
So is the real investable opportunity possibly in the picks and shovels layer rather than the AI platforms writing the checks?
Chip prices rising for the first time in 2 decades reflect that. But it's not inherently risk-free, right? It's just a different type of risk. So think suppliers have no demand independent of these hyperscalers right now. And so the lack of diversification on the balance sheets to absorb that slowdown is inherently a risk in itself. And I guess these companies would trade risk for that concentration risk.
So Evercore and BofA now project combined big tech CapEx clearing 1 trillion by 2027. And some forecasts put annual hyperscaler spending at 2.5 to 3% of US GDP. Is this the new normal capital intensity of the AI era, like telecom building in the 90s? Or are we setting up for the most expensive correction in tech history? Scary.
You want the honest answer? The honest
Sure, why
answer,
not?
we really don't know yet, right? You can have a case for either side, right? Say the new base case for AI, right? The infrastructure could genuinely be foundational, like the electrification. You have closed loop system or data centers now. So you're advancing industry outside of it, right? Google's cloud, I think it's 160 billion backlog suggests that there is real demand that exists. But on the other side, you have the correction case, right? Every super cycle like telecom or housing that we saw over the last couple of decades saw a real demand erupt, but only after a brutal repricing kind of wiped out the over leveraged players. So negative free cash flow, rising debt, and single utilizations look back at like a land grab as opposed to more disciplined player in it. So in my opinion, I don't necessarily think it's binary. The technology may justify higher capital intensity, higher capital and long-term investments, but it's the pace of financing and the debt funding this would be a low utilization rate. It looks unsustainable, right? So it's Amazon versus Pets.com, right? The thesis was right, but investors still lost fortunes betting on the wrong balance sheet and timeline.
Okay, so let's talk about the revenue coverage problem, which is pure play AI companies like OpenAI and Anthropic combined are generating maybe 35 billion in annual revenue against roughly 700 billion in hyperscaler infrastructure spend. Call it 5% coverage. How long can that gap persist before either enterprise adoption has to dramatically accelerate or someone blinks on spending?
So that number has actually moved quite a lot. Between Anthropic and OpenAI, they now run combined about $76 billion, pushing the coverage closer to 10% rather than 5%, right? The core problem is concentration risk, right? So much of that revenue comes with massive losses. OpenAI reported about $21 billion against a 13 billion revenue back in 25. And then growing revenue doesn't mean the economics work on it, right? The gap can persist while hyperscalers are also betting against their own cloud businesses. Eventually adoption has to scale, or capital markets have to force discipline through higher borrowing costs.
All right. James Yendrey of InvestMentor, thank you so much for shedding light on CapEx. We really appreciate it. And thanks for joining us today.
Yeah, thanks, Mary. Great being here.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.
IBKR Invest Mentor is a service of Interactive Academy LLC, an affiliate of IB LLC and majority owned by IBG LLC. All content provided by IBKR Invest Mentor is for informational and educational purposes only and should not be interpreted as implying any sponsorship, partnership, endorsement, recommendation, or approval by IB LLC or its affiliates.